47% of all buy now, pay later users in America have made at least one late payment in the past year, up from just 34% 2 years ago. And as of April 2026, Affirm has officially begun reporting every single pay-in-4 loan directly to Experian. So while millions of Americans continue clicking that little pay-in-4 button at checkout believing it is harmless, the credit reporting system has quietly been rebuilt around them. And we believe this is leading to one of the most underestimated personal finance risks of the entire decade. The buy now, pay later market in the United States is now estimated at roughly $128 billion in transaction volume for 2026, up from essentially nothing a decade ago. And we can see that by looking at usage data from LendingTree, which shows over 52% of all Americans and 61% of Gen Z have now used a BNPL product. The average user holds multiple loans simultaneously. In fact, 60% of users carry more than one active BNPL loan at the same time, and 33% are using multiple providers at once: Klarna, Affirm, and Afterpay stacked together. You see, the reason this matters today in a way it did not matter even 12 months ago is because the credit infrastructure has fundamentally changed. Until recently, almost none of this debt was visible to the credit bureaus. The companies marketed their products as no credit check. Consumers assumed that meant no credit impact, and for years that was largely true. But quietly, FICO launched a new scoring model in 2025 specifically designed to ingest BNPL data. They called it FICO Score 10 BNPL. And the FHFA has now adopted VantageScore 4.0 for federally backed mortgages, which also incorporates this alternative data. So the rules changed, and the consumer was not told. Now look at where this is already showing up in real life. In December of 2025, the Attorney General of North Carolina sent formal letters to the 6 largest BNPL firms: Affirm, Afterpay, Klarna, PayPal, Sezzle, and Zip, flagging a growing pattern of consumers being denied mortgage applications because of undisclosed BNPL obligations. Mortgage underwriters are now asking applicants to self-disclose every single active pay-in-4 plan because these obligations skew debt-to-income ratios in ways that traditional credit reports historically missed. This is the silent default crisis. People with what they believe is good credit are getting rejected at closing, and the comparison being drawn inside the industry is rather uncomfortable. Capital One co-founder Nigel Morris has compared the current BNPL trajectory to the lead-up to the 2008 mortgage crisis, noting the risk is largely invisible because the providers do not share data with one another. A consumer can be approved for a 4th loan from Klarna while already drowning in obligations from Affirm and Afterpay, and none of the 3 platforms can see the full picture. Now you might be thinking, I have been using these apps for years and my credit score is just fine. And until recently, you would have been right. But the problem is that the protective gap between BNPL and your FICO score has now closed. FICO's own analysis indicates that for Affirm users, the inclusion of BNPL data shifted credit scores by roughly 10 points for over 85% of those surveyed. And for users with thin credit files, the impact runs considerably larger. A single missed payment on a reported BNPL loan now stays on your report for the full 7 years under FCRA rules. And the real cost of this is not the missed $50 payment. It is what happens to every other interest rate in your life. Experian's Q4 2025 data shows the spread between super prime and deep subprime auto loan rates is now over 11 percentage points. According to MoneyLion, borrowers with poor credit pay roughly $599 per month more across all their financial products combined: loans, insurance, credit cards. Over a working career, that is hundreds of thousands of dollars quietly extracted from people who clicked a button they thought was free. So the question becomes what to actually do about it. And we think there are 3 things every viewer needs to handle this month. The first is to pull your free credit report at annualcreditreport.com and identify every active BNPL account currently reporting. The second is to pay off any open balances in full, because under the new FICO 10 BNPL model, these now feed directly into your utilization ratio. And the third is to stop opening new BNPL loans for at least 6 months, so that your average account age can recover. There is a narrow exception. For consumers with very thin credit files, Affirm's longer-term loans paid on time can actually help build a positive history. But the rule we keep coming back to is simple. If you cannot pay it in cash today, you cannot afford it on pay-in-4. Treat it like a credit card you did not plan to open. The reality is that buy now, pay later is no longer the consequence-free cash flow tool it was marketed as. The reporting infrastructure is in place, the scoring models are live, and the mortgage denials have already started. Pull your report this week, close the open accounts, and the next time that little Pay in 4 button appears at checkout, remember that in 2026, it is no longer free. Thank you for watching.